Hello and welcome to this week's episode of The Capitalist Investor. You got your boy Diamond Hands D here, and once again, Tony the Tiger Zabigala.
What's up, baby?
What's going on, man? How are you?
Good, man.
So when did Tony the Tiger happen? I heard the podcast when I was gone. I didn't know that was a thing.
I have so many weird nicknames. Zabby Dabby Doo, and Tony the Tiger. That one's easy. That's just cereal when you were a little kid.
Oh yeah,
right?
Absolutely.
So,
all right. Well, this week we wanted to talk about taxes because I think it's really one of the main topics out there right now. A lot of people are concerned about it, as they probably should be, from the new administration. What's likely to happen if they get this infrastructure, quote unquote, infrastructure plan passed. There's going to be a sizable tax increase behind it to pay for it, despite what you may be hearing. That is the reality of the situation. So we've been, fielding from our clients lots of questions and about taxes and what we should do. So I found this article out there on Kiplinger's. We will link it in the show notes. 12 questions retirees often get wrong about taxes in retirement.
right. And I mean, this is where, like a retiree should, is nervous, should be nervous because, like what's on the other side of that door, right?
Yeah, absolutely.
And so, as we looked at this article together, like they have 12 questions. And it's not a single question I haven't heard. I think we're going to save some people some time on certain sections, but I want to elaborate on some of the questions that were asked because I get them nearly every day. And there's no clear-cut answer to some of these. So I know that I've written down some notes, and I'm going to try and break it down. So I'm excited about this one. We're going to blow through some because it's pretty straightforward.
Right.
And let's get going.
All right. And, I mentioned up top, about the word retirees is in this article. But if you're not a retiree or a pre-retiree, these questions still apply to you because you actually have a lot of time to do something about these problems that could happen in your retirement. So we'll get into those aspects as well. So
yeah, to elaborate just on that really quick is that, tax planning for retirement can start 5, 10, 15, 20 years from retirement because it's not like you just jump on the other side and things change.
Yep.
You can set up a lot of things today for that time frame. It's not like, oh, I'm a year away from retirement. Like, what can I do?
Right,
Like,
exactly.
Not much, probably.
Exactly. So yeah, and that's when we would teach classes at a college or things like that. Probably one of the things I most often got after class was, man, I wish I had taken this class 10 years ago.
Yeah.
Right. I'm sure you got the same thing.
Yeah.
Every time.
Yeah, and this is a crash course in taxes.
Yeah.
Honestly, through the eyes of a financial advisor.
Yeah.
Right.
Absolutely.
So, all right. First question I saw is, when you retire, is your tax going to be higher or lower than when it was when you were working? I mean, it depends, right? I mean, like, it's just such a loaded question. So the way I see it is that most people have saved their money into a 401k, and they have done the tax deferred route where you get deductions and things like that. So when you retire, it's all taxable. So depending on your lifestyle, if you're spending 70 grand a year, that money needs to come from somewhere. Obviously, you'll get some Social Security, hopefully, down the road,
Yep.
depending on how old you are. But let's just assume Social Security is not part of the equation. I need 70 grand. Well, I am taking a $70,000 distribution, and it's all taxable.
Right.
So what bracket does that put me into, right? Somewhere in the 12, I'd
Probably
imagine.
the 12. Yeah.
But but that doesn't mean I'm going to pay an effective tax of probably like 7 or 8.
Right.
Right. So.
Yep. So you hit the nail on the head there. And that's something that the younger people can do right now is to not save all of their money into a qualified plan. Because yes, probably 90% of the people we talk to probably 90% of their retirement savings is in their 401k or a 403b at work. So as you pull that out in retirement, that is all fully taxable.
So now I thought of a question inside of this question that I hear all the time. All right, Tony, if it's all taxable, should I start putting all my money towards the Roth 401k? And I think it's a loaded question because we know taxes are going up. We know tax-free income's a good thing, but you're sacrificing either in the front end or the back end. And what I mean by that is if I contribute to a 401k on the tax-deferred side, I get a deduction today, right? And if my income is high, I want that deduction.
Right.
Because if I'm making 150 grand in working today, but my lifestyle is only 70,000, my income in retirement is 70,000. I'm going to be in the 12% bracket. If I'm making $150,000 today, I'm probably in the 24% bracket.
Yep.
So I would rather save 24 cents on the dollar because my income is going to be lower in retirement than it is when I'm working.
Yep, for sure. And that's why financial planning is such a huge part of having a successful retirement, because most of these questions are not yes and no answers. It's going to depend on your situation.
Right. How much money do you spend? How much money do you make? What does retirement look like?
Absolutely.
Right? There's all those different things. Can I definitely argue saying, why don't you split the money? Sure. But I really want to know how much money we can save in taxes today, because I can't predict the future. Well, taxes are going up. When and how much? We don't know what that really looks like. So all I can do is plan on what I know today.
Absolutely. Yep. So question number 2, I'll let you handle this one. Are my Social Security benefits taxable?
Yes. but here's the thing. It all depends on like what you did in question number 1. How did you save your money?
Right.
Did you save it in cash? Did you save it in a tax deferred traditional 401k, traditional IRA, or is all your money in the Roth IRA? Because if all your money's in a Roth IRA and you take distributions, you have zero income.
Right.
And there's certain thresholds in Social Security where you will pay zero tax on your Social Security paycheck, right? Yep. So again, it's which bucket is your money in? Taxable, tax deferred, or tax free? And this is where, I know as our firm adds a lot of value. We have a CPA that helps our clients do their taxes, but he talks to me.
Right.
And he is able to provide me with the distribution strategy based on where people's money is located, right? Because if we have different pockets of money, there is a sequence that we can pull that money out on a year-to-year basis to figure out what the lowest tax ramification of that is.
Absolutely. And that's such a great point too. Just talking with people, kind of about the business over the years, I feel like that is one of the biggest misses that people make, is not having their financial advisor or whoever's managing their investments talking with their tax person.
Yeah.
And it's nothing against tax people at all, but I would say most people who are doing taxes are pretty much in the tax preparing business, which is fine.
Right.
They're just preparing the 1040, seeing if you owe or if you're getting a refund, and that's kind of it.
Yeah, they look at this year's taxes. They don't look 10 years from now saying, hey, if you do this tax move, it might cost you a little bit more money today, but it is going to reap benefits 10 years from today.
Absolutely.
They're not looking at it and through that lens, I guess you can say.
For sure.
One of the other question that I on the distribution strategy to help lower taxes. I love this question. When the first time I meet somebody and I sit down and I'm like, so you have all this money. What is your strategy for creating your own paycheck? Well, I got this Roth IRA. It hasn't really been performing that well, and I'm just going to take the money out of there, and the first few years of my retirement are going to be tax-free.
Right.
Okay. What happens when it runs out? How much tax are you going to pay then? Right down the road.
Right.
So that's I can understand that, but don't blame the Roth IRA, and blame the investments there.
Exactly.
It could have been an all-star for all we know. Don't blame it on your worst account. Blame it on your strategy of what pockets of money you want to pull that from. So
Yeah, and we have we always reference, I believe it's a Vanguard study, and just pulling your money out in the proper order can add years onto your retirement income. And typically, again, it's not for everybody, but typically the most efficient way to spend is starting with the non-qualified assets and then moving to the qualified and then finally moving to the tax-free like the Roth. So that's typically the way it works. But again, everyone's situation is going to be a little bit different.
yeah, depending on what's going on, you could be pulling from all three buckets. There's definitely ways to do it. All right, moving on to the next question. Some of these are going to go quick, so I forgot to say that up front. Some of them are like yes, no, moving on.
Right.
And the first two were definitely, I feel, real wedges to really drive into
important.
retirement planning. Next one, can you still contribute to an IRA after you retire? No. If you are officially retired and not working at all, zero W-2 income, you can't do it.
Yep.
Done.
You got to have earned income,
Got
basically.
to have earned income, and pulling money out of your IRA and pension money, that doesn't count. Do you have like, a side hustle in retirement? Are you doing something? Are you working? That's the only way that you can contribute that money.
And that's a lot. That's part of people's plans too. Semi-retirement. I've worked with several clients that is the case, and they're making, $20,000 a year working part time, and they're saving,
Yeah.
$10,000 to a Roth,
Right.
between them and their spouse. So
Yeah.
it is possible, but once you turn off that income, no more contributions.
Yeah. Are you officially retired or still working?
Right.
That's it. All right. Question. Are withdrawals from Roth IRAs tax-free once you retire? Yes, but you have to satisfy two rules.
Yep.
Right? There's the 59.5 rule. So you have to be over 59.5 to avoid the 10% penalty
Right.
on the gains. And then you also have to have the Roth IRA open for 5 years to extract the money tax-free, the gains tax-free. So there's two rules you have to qualify for. That's why when, you brought up, us teaching the classes. Way back in the day when Mark and I did a radio show, we talked about in the beginning of on January 1st, put $1 in your Roth IRA. It'll count for last year's contribution. And it was just to get that 5-year clock started. Can you open a Roth IRA for $1? I don't know, maybe not. But it's more principle. It's more theory.
Right.
You gotta open the account and fund it.
Yep.
To get that clock started.
All right. Next question. Post-retirement rollovers from a 401k plan to a traditional IRA tax-free? And the answer to that is yes.
Yes.
So, you're going to want to make sure you do it properly. It's called a direct rollover.
Right.
So you basically call up your 401k plan. You ask to do a direct rollover.
And don't be lazy. Don't call it a rollover because that's when things could get messed up. They can withhold 20%, which we don't want them to do. We got to call it a direct rollover. That is the correct word. It's, don't be lazy.
If you ask for a rollover, they will send you a check made out to you worth 20% less than what was in your account.
Right.
So make sure you don't do that.
Yeah.
The check should be made out to the new custodian, so like TD Ameritrade,
Right.
For benefit of you. That's how it would be made out to. And then you can deposit that right in your new IRA account, and that is a tax-free transaction.
Right. There are no taxes associated. If you call it a rollover, they could possibly write the check in your name. The government does not trust you with their money, so they will withhold that 20%. That's the way I describe it. Now, that is just a transfer. That's going from a traditional IRA, a traditional 401k to a traditional IRA. Maybe you have some after-tax dollars, and it's a Roth IRA money involved. But distributions will be taxable. So that, we just need to understand that. We're just talking about the direct rollover component of this.
Yep.
All right.
All right. So the next question, is the income you receive from an annuity you own taxable?
All right. So again, it depends on what bucket of money you put into the account, right?
Yep.
So if it's your traditional IRA money, if it's an IRA, 100%. The rules don't change because it's in an annuity, right?
Yep.
If it's non-qualified, so if you put cash in there, you thought you can do better than maybe a CD or something like that, or a bond, you put your money into your cash into there. The gains of that are taxable.
Yep.
Just the gains. And then if it's Roth IRA money, no, the distributions are tax-free. So again, it's a loaded question of what type of money did you put inside of that annuity.
Yep, for sure. All right, this is a good one because we get this a lot, and it doesn't just apply to people who are retired. Like I said, you can be making moves, so this doesn't affect you as much down the road. But at what age must holders of traditional IRAs and 401ks start taking required minimum distributions? So a required minimum distribution is basically the IRS saying, hey, you've been able to save all this money into your IRA or your 401k or 403b, and you've been getting a tax deduction on that for basically your whole life. And then the gains in that account, you're not getting taxed on those as they go. But when you start, if you don't pull money out of there, the government's going to make you start pulling money out of there.
They want their money back.
Yep.
All right. So, but let's even peel off let's peel the onion back just a little bit. Mm-hmm. If you were saving the money into the Roth component of your 401k, there are no RMDs for Roth assets.
Right.
Right. Mm-hmm. So age is 72. That changed a year or two ago, right?
Yep.
Now, this only happens if you are retired and have no W-2 income. So like there's this could be a way. So like let me just use an example. 72 is when RMDs start. Let's say I'm 74 and I'm working, okay? Mm-hmm. And I'm still contributing to a 401k. I do not, because I'm still working and contributing to that company's 401k, I do not have RMDs.
That's a very important point.
Right? It is the year that after I retire is when my RMDs will have to start. Now, here's another layer. Now, let's say you have a 401k and you're 74 years old and you're contributing, and then you have some IRAs outside of that. Mm-hmm. Those do have RMDs.
Yep.
So, it all depends on the situation. That is the only situation I can think of that somebody over 72 will not pay an RMD. And that's if they are still working for the company that they are contributing a 401k to.
Yep, important points. Yep. And if you forget to take your RMD, you're in big trouble. I believe it's 50% penalty.
Yeah, so, and the tax. So you're going to get 25 cents on the dollar.
Yep, so not good. And again, something you want to plan for in advance. So obviously the less money you have in the qualified tax bracket or tax classification, the lower your RMDs will be. So, there's multiple strategies inside of a financial plan to address that. That's something you'll want to talk with your advisor about.
Yep. All right. Next question. Are RMDs calculated the same way for distributions from multiple IRAs and multiple 401k plans? So really simple. The IRS looks at all tax-deferred accounts on an aggregate level. So I might have $1 million spread across two accounts, $500,000 each. They look at it as $1 million IRA. Mm-hmm. Doesn't matter, the accounts and everything. When you turn 72 and a half, the distribution rate is 3.65, and it only goes up every year you get older. Right. They want their money and they want it faster. Right. Yeah. So the tax, the RMD on that would be $36,500.
Right.
I can take it from one of the $500,000 accounts. I can split it up. I can do whatever. I just need to make sure that I take out at least $36,500 that year, regardless of what account it comes from.
Yep, absolutely.
All right.
So multiple accounts, you need to take out the aggregate amount, and the RMD, how much you need to take out, is basically just based on your age. So you can look up a chart. We'll throw it in the show notes as well. But that RMD is going to go up every year that you get older. So, and Tone, when do you need to take out that first RMD that you turn 72?
All right. Well, the next question is, do you take your RMD on December 31st of the year you turn 72? So you always have to take it out before December 31st, right? Mm-hmm. the year you turn 72, this is like one of those, obviously a once in a lifetime thing, right? So do you have to take it before December 31st, the year you turn 72? So the answer is no, actually. Normally you have to take out the RMD at age 72 by the end of the year. However, you can take your first RMD up until April 1st of the next year after you turn 72. It's just one of those weird little rules to mess everyone up. But that's just a straight rule. I have no comments on that. Moving on.
It's April 1st, not April 15th.
Yep. It's April Fool's Day. Gotcha.
Yep. And if you wait until April 1st to take your first RMD, you'll have 2 RMDs in that same calendar year.
Yeah.
So we usually advise against that. Again, that's going to depend on your situation, but probably don't want to do that. But again, something you should look into.
Yep. The next question on that's Kipplinger's list, number 10. You're married, your spouse passes away, and you get a life insurance payout. Do you have to pay taxes on this? No taxes on death benefits from life insurance policies. It's clear as day. So there's nothing I can think of then on that side of the equation. So,
all right. So, a couple quick ones, and then we'll wrap up here. How valuable must an individual's estate be at death to be hit with federal estate taxes in 2021?
All right. Well, we know 2021 because they haven't changed any of the tax rules yet, right? So it's $11.7 million per person. If you're married and you pass away, the exemption goes up, it doubles, right? It's $23.4 million. So if you're not worth over $24 million, don't worry about federal estate tax.
Right.
However, that could definitely change next year.
Yeah. So I would suspect that this would be a key thing that the Biden administration would try to lower so they generate more taxes. But again, we're guessing at that. We don't know that for sure. But as of right now, you need an estate bigger than $23.4 million for a married couple before you start to get into estate tax.
Yeah. I mean, we could have a whole podcast on what we think they could do.
Right.
And I just,
I'm pretty sure we did.
I'm pretty sure, yeah. And it's probably changed since then. I heard some more stuff going on as of this morning, some articles I was reading about it. So my head's spinning already. So,
yep.
All right.
All right, let's hit the last question. We'll get out of here. So if you're over 65, can you take a higher standard deduction than other folks are allowed? So can you take a higher standard deduction if you're over 65? So the answer to that is actually yes.
It's weird. I mean, this is something that if you're getting your taxes done by a CPA, hopefully they know this.
Right.
If you're doing it on your own, hopefully TurboTax is up to date and gives you that warning. But you get to deduct just a little bit more. It's like $1,500. For 2021, it's $1,700. So if you're filing jointly.
Yep.
So there you can go slightly above. It does help, obviously. But this is something for tax time next, February, March, April. That you now that you're aware, if you do your own taxes, and God help you. You hope your CPA knows.
Hopefully, if they pass their CPA exam, they know that rule.
Yes.
So. All right, last one. Should you pay your mortgage off if you're retired?
This is a bonus. Was that a
bonus?
Question? Bonus?
Right off the top of my head.
Oh man, I'll let you go first.
All right. So I get that question basically from every client, and it goes into that standard deduction question. That's why I thought of it. So if you're paying interest, on a mortgage, that is still a tax deduction. So, and interest rates are so low. So my answer to that is no. You don't have to be debt-free to retire. You don't have to pay off your mortgage before you retire. You definitely don't want to pull out qualified funds and pay taxes on it to pay off your mortgage. So my answer to that is typically no. It's okay to have a mortgage in retirement, and you don't need to pay it off.
Right. And I mean, honestly, that's why you get a financial plan done.
Yeah.
So that we can show. Think of it this way: if you have an all-star financial plan, a green light plan is what I call them, The whole thing behind it is that if it doesn't upset the results of your plan, do whatever you want.
Right.
If it makes you sleep better at night, be my guest. But have this in the back of your head. If your hurdle rate, the mortgage rate that you're paying is, let's just call it 3%. It's maybe even lower these days, right?
Mm-hmm.
Like 2.85, whatever it is. If you don't think you can make over 3% in your investments, then pay off your mortgage.
Right.
If you think your account can earn 5, 6, 7%, why would you pay off something costing you 3%?
Right.
The arbitrage is not there. Right? If you're sitting in cash and losing out to inflation, I would tell you, yeah. Right? Because if you're just a nervous Nelly sitting in cash, well, yeah, go be my guest. Like you're losing out to everything around you anyway. But you know, I don't know. That's the way I describe it. Like the hurdle rate is 3. If you don't think you can earn over 3, then pay off your mortgage.
Absolutely.
But I always take it to the financial plan and let it tell me and let me show the client saying, hey, these are the consequences, and they might be, you know, nothing. It might not cost. It might not change your plan one bit. I've seen it wreck some people's plans.
Yeah, for sure.
So it
No
all
doubt.
depends on what you're doing, because like you said, if you have to take the distribution from your IRA, you know, now you're paying taxes on that, but you have to take out, I don't know, $200 to pay off a $150,000 note.
Yep.
I don't know. It might not make sense.
For sure. So that wraps it up for this week. So, you know, make sure you're considering the tax implications of all these moves, you know, especially as you're approaching retirement. It's super, super, super important. So hopefully this helped, you know, get your mind around all the issues out there.
Yeah. And also for one of our upcoming podcasts, I'm kind of excited about it. You know, you and I have talked about this. We have a friend that's really big into NFTs, non-fungible tokens.
Yep.
Nobody knows what they are. Nobody knows why people would buy them. But I'm going to have a podcast on it. I got involved because I just hear
I saw that on Twitter.
Yeah, I got involved. I didn't spend a lot of money. So, you know, it's not like I bought this $300,000 NFT that you see on CNBC every now and then, but a couple $100 just to get into the game, understand what's going on, how it works, what the community looks like. And that's the biggest part, man, is like, there's this like weird community out there for NFTs, and I mean, I get it, but I don't. So I'm very on the fence. I'm like, I get it. It's I have an addictive personality, so I'm getting pulled into this little thing. So I'm looking forward to the podcast on that. We're gonna have one of our friends who's been really involved in it. He knows exponentially more than you and I would ever know probably at this point. And I'm excited to have him on. I'm excited to share my experience of how to buy it and then what I'm seeing after I bought it.
Right.
Because it's not just like you buy it and then it's over. There's cult-like following. There's this community around every NFT that you buy. It's crazy. It's definitely time for a podcast to do that. But all right.
All right, so we'll check that out soon. So thank you, everyone, for listening. As always, if you can drop a subscribe on us, I would appreciate that. And if you leave us a 5-star review, send us a quick note to info@swpconnect.com, and we'll send you some swag. I think we got some new swag on the way for the fall. So thanks for listening, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.